What up, YouTube? It's your boy Charles Enoch. Y'all already know we back with another Invest in Myself episode. So run the intro. So the other day I received an email from a subscriber and they wanted me to go over another scenario on how to pay your credit card off without paying any interest on it. And the subscriber wanted me to use him and his wife's finances. So I decided, hey, why not? Let's put their example on the whiteboard. But before we get started, you already know I got to do the YouTube thing. So your boy's getting close to being monetized. So I'm going to ask you guys, help a brother out. Go ahead, smash that like button for me if you haven't done so yet. Make that thing turn blue. If you're new to the channel or just have not done so yet, take a little time, hit that subscribe button for me. And also share the video for anybody you feel that this may help. And leave a comment down below if this was helpful to you. I appreciate anybody that takes the time to do all these because it does help me reach a higher audience base. So the concept that we need to understand when we're doing velocity banking is that our income will pay our credit and then our credit will pay our expenses. Putting all your income on the credit card is going to pay the credit card off in full in this particular scenario I'm going to show you. Once you pay your credit card off, then you will use your credit card to pay your expenses. If you have more income than expenses, then you're going to see a leftover amount on your credit card, which that would be your cash flow. Pretty much your income minus your expenses, whatever's left over is your cash flow. So pretty much every month, you're going to keep your cash flow onto the credit card until it's paid off in full. Now, I know this may sound complicated, but you already know I got the whiteboard in the back and we're going to break it down using this couple's scenario. Let's go. All right, so on the whiteboard, so you already know I get down to business here. So this couple, let's kind of look at their financial situation here. So their income combined together every month is $7,000. Their expenses are $4,600. The rent that they pay is $2,000. So their total expenses together is $6,600. which that is going to leave them at a cash flow of $400. They recently went on a trip and they spent $5,000 onto their credit card. It was like the minimum payment on their credit card is $200 and their interest is $23. So they're wanting to get this credit card paid off without paying any interest. So first, we do have to remember our income is going to pay the credit, and then the credit is going to pay our expenses. All right, so we're on the other side of the board. We're going to take a look at the months. I always just start for January, even though it is not the month of January. I'm just going to assume that it is. So what particularly we're going to do, we're going to look at our equation in regards to how this all works. So we're going to take $5,000 of the couple's income since they get $7,000. We're going to apply this onto the credit card, the $5,000 that they owe on the credit card. This is particularly going to pay the credit card off in full. And when you pay it in full, there's no interest, right? So what that does is it actually is going to increase your cash flow by $200 because the minimum payment was $200 a month. It is no longer expense for that month because you paid the credit card off. This also reduces your expenses by $200 because some of the expenses, the $4,600, 200 of it was your credit card. So that is going to be reduced by 200. Now the next step, they're going to take the $2 extra $1,000 that they have since they get $7,000 and they're going to pretty much pay their rent. So once they pay the rent, then their expenses are going to be $4,400. Remember, we had $200 minus on the expenses because the credit card was paid in full. So if we look, the rent is paid and then the expenses went down by $200. So our next step, we're going to use our credit card. We have $5,000 on the credit card because we paid it off in full. And then we're going to use our credit card to pay our expenses, the $4,400. This is going to leave a remainder balance of $600. So at the end of the current month, the debt will be $4,400, and then the amount paid on the card is $600. And we avoided interest because we paid it in full. All right, so we're on the next month here. So we're going to look at the end of January. The debt on the car was $4,400. So we're going to take $4,400 of our income. We're going to put that onto the credit card, which is obviously going to pay that in full. So we see that our cash flow increased by $200 and our expenses decreased by $200. So instead of cash flow $400, cash flow is going to be $600. Our expenses went down from $4,600 to $4,400. Now what we're going to do is take our remainder income, $2,600, and first we're going to pay the rent. The rent's $2,000. We're going to pay that off first, and then the remaining $600, we're going to apply that towards our expenses, which our expenses are going to equal $3,800 that we have to pay off. Now, how are we going to pay that off? We're going to pay it off with our credit card. So we have $5,000 onto the credit card and our expenses are $3,800 left. This is going to leave us with $1,200 on the credit card. So in the end of February, our debt is $3,800 and we have paid $1,200 onto the credit card and no interest has been applied, because remember, we are paying the credit card off in full every single month by shoving our income into the credit, and then our credit is paying our expenses. All right, so we're on the month of March. So what we need to do here, we got to look at how we ended in February. So the total debt on the credit card is $3,800. So what we're going to do, since our income is $7,000, we're going to take $3,800 of that income. We're going to shove it onto the credit card to pay the credit card off in full, avoiding all the interest. Then what that is going to do is going to increase our cash flow by $200, and it's going to decrease our expenses by $200, because remember, the credit card, the minimum payment was $200 and that was part of an expense. But when we pay it all off, it's no longer an expense, right? So the next step, we're going to take the remainder of our income, which is going to be $3,200. We're going to first pay our rent. After we pay the rent, then we're going to apply $1,200 on the expenses. Remember, the expenses are $4,400. That is going to reduce it to $3,200. Now, how are we going to pay our expenses? We already know that our credit card, is going to be paying those expenses. So our credit card has $5,000 on it because we paid it in full, right? And then we're going to apply that towards our expenses. Our expenses are $3,200. We do the math, we're going to be left over with $1,800. So at the end of March, it's looking at our debt is $3,200. We have paid $1,800 on the credit card. And again, we ain't got no interest on it, babe. All right, so we're in the month of April. So we got to look at what our debt was at the end of March. So our debt is $3,200. So what we're going to do is use $3,200 of our $7,000 of income that we get every month. And we're going to apply that to our credit card to pay the credit card off in full, avoiding all interest. Now, what that particularly is going to do is going to free up some cash flow. It's going to free up $200 of cash flow, and it's going to minus our expenses by $200. Because remember, the minimum payment on the credit card is $200, but when you pay something off, it's not an expense anymore. So our next step is we're going to take our remainder income of $3,800. We're going to apply that first towards the rent, pay that thing off so we got somewhere to live. Then the remainder of our money, which is going to be $1,800, we're going to put that onto our expenses. So remember, our expenses are $4,400. That is going to reduce it to $2,600. Now, since our credit card is in full, this is how we're going to pay the remainder of our expenses. We avoided the interest already. So we got $5,000 on the credit card. We're going to use $2,600 to pay those expenses off. Now the difference between that, we're going to be left with $2,400 on the credit card. So if we look at it for the month of April, our debt is $2,600 and the amount that we paid on it is $2,400, and we avoided the interest because we're paying the credit card off in full every single time. All right, so we're in the month of May. So what we have to do is look at how we ended the month of April. So our debt for the end of April was $2,600. So what we're going to do is take our $7,000 of income. We're going to take $2,600. We're going to apply it to our credit card to pay it off in full, meaning that we avoided any interest on the credit card. And then what that is going to do is going to increase our cash flow by $200, and then it's going to decrease our expenses by $200 because the credit card is paid off. It's not an expense anymore. Second step here, we're going to take the remainder of our income, $4,400. We're going to first pay our rent. After we pay our rent, we're going to use the remainder $2,400, and then we're going to pay a lot of our expenses. Remember, our expenses are $4,400. That means that it's going to reduce it to $2,000. Now, how are we going to pay those remainder expenses? Remember, we paid our credit card off, so we're going to use the credit to pay the remainder of the expenses. So our credit card has a $5,000 balance on it. The expenses are $2,000 remaining. So the difference would be $3,000 that would be left on the credit card. So if we take a look at May, our debt is $2,000. We paid $3,000 on it. And again, our interest is zero because we're paying the card off in full every single month. All right, so we're in the month of June. So what we need to do is we need to see what last happened in the month of May. So our debt in the month of May is $2,000 at the end. So what we're gonna do is take $2,000 of the $7,000 of our income, and we're gonna apply it to the credit card, paying it off in full, meaning that we have not paid any interest because we paid it off in full for that month. This is going to increase our cash flow by $200 and decrease our expenses by $200 because remember, the minimum payment on the credit card is $200. If you pay it off in full, it's not an expense anymore. So next step, our income, the remainder income is $5,000. We're going to first pay the rent, keep the roof over our head, and then the remainder amount of that money, the $3,000, we're going to apply it towards the $4,400 of expenses, leaving it at $1,400. Now, how are we going to pay the expenses? Remember, income pays credit, credit pays expenses. So our credit card is going to be the thing to pay our expenses. So our credit card has a balance, it's paid in full, or it doesn't have a balance, it's paid in full, $5,000. So we are going to apply $1,400 of that for the expenses, leaving the balance now at $3,600. So if we look at the month of June, our debt is $1,400. The amount paid on the card is $3,600. And again, we still have not used any interest. No interest has applied to us. All right, so we're in the month of July. So what we need to do is figure out what the debt was at the end of June. So the debt at the end of June was $1,400. What we're gonna do is pretty much use some of our $7,000 income. We're gonna use $1,400 of it to pay our credit card off in full, thus avoiding all interest that they would charge us. And what that's going to do is going to increase our cash flow by $200. It's going to decrease our expenses by $200 as well because the card is paid off in full. Next step, we're going to use our remainder income, $5,600. We're going to first pay our rent. And then next, we're going to use that remainder income, $3,600. and we're going to apply that towards our expenses of $4,400. That's going to equal $800 left in expenses. Our next step, since our credit card is paid in full, we're going to use some of our credit card to pay that remainder balance of the $800 for our expenses for the month. That is going to leave us at $4,200 left on the credit card. So for the month of July, our debt is $800. We have paid $4,200 down and still have not got charged any interest because we pay the card off in full every single month. We almost got this thing paid off. We're in the month of August, so we got to see what our debt was at the end of July. So our debt was $800. So we're going to use $800 of our $7,000 of income, and then we're going to put that onto the credit card to pay it off in full. We're avoiding all the interest. Now it's going to increase our cash flow by $200 and decrease our expenses by $200. Our next step is we're going to use our remainder income, the $6,200, pay our rent off, keep the roof over our head. Then our expenses, we're going to use $4,200. So pretty much the difference from the $6,200 and the $2,000 that we spent. And it's going to leave us with $200. Remember, our expenses are $4,400. We got $4,200 in cash, right? So the expenses are $200 left. How are we going to pay the rest of that? We're going to use our credit card. So we got a credit card has a $5,000 limit on it. We paid it off in full, avoided the interest. So we're going to use $200 of the $5,000 we have, and it's going to leave us with an amount of $4,800. So if we look at the month of August, our debt is $200. The amount that we paid is $4,800. All right, we're on the last month. We're on the month of September. We need to see what our debt was at the end of August, which was only $200. What we're going to do, we're going to use $200 of our income. We're going to put it on the credit card. That pays that thing off to full. It increases our cash flow by $200 and decreases our expenses by $200 because the credit card is paid in full. It's not an expense anymore, right? We're going to use the remainder of our income. We're going to pay our rent first off, keep the roof over our head, and then we have enough money to pay our expenses. Our expenses is only $4,400 and we have $4,800. This leaves our expenses at zero. So guess what? This last step, we don't even need to do the last step. So we're not using our credit card to pay our expenses because our expenses are paid in full, which means we paid the credit card off in full and we avoided any interest being charged. So the month of September, the debt is zero. The amount that we paid was $5,000 and we have all completed it here. In 9 months, we paid $5,000 off. So remember, the key thing when we're doing velocity banking and trying to pay off the credit card, we're using the credit card as our bank account. We're putting the income onto the credit card and then using our credit card to pay our expenses. Income pays credit, credit pays expenses. If you learn how to do that, you can either pay 0% interest or you would pay a low amount of interest if your income's not able to put all the money onto the credit card and pay it off in full. At least you're reducing the interest on the credit card. So I hope this has been helpful. If so, definitely leave a comment. If you need me to do another example or scenario, or you want to do a different scenario, you can leave a comment. You can definitely email me. And if you haven't done so yet, definitely remember to subscribe to the channel. And like always, you guys have a good weekend. Peace out.